Good day. It's nice for me to be here with you today. Today we'll be looking at amalgamation accounting. Amalgamation accounting. But before I proceed, I would like to share the lesson objective with you. Uh, at the end of the lesson, students should be able to define amalgamation accounting, explain the types of amalgamation, state the procedures for amalgamation, and prepare the amalgamation accounting. So let us look at the meaning of amalgamation. That is, amalgamation can be defined as joining or combine or coming together of two or more independent companies in order to form a unique company. So this is when a company and B company come together for the purpose of forming a unique company, a unique company. Then this amalgamation can also be defined as a combination of two or more companies into a new entity, into a new company, by combining the assets and liability of both entities into one. So their assets and liability of company A and company B need to be combined together to form a unique company or to form, a unique entity. So that is an amalgamation of accounting, amalgamation of accounting. So this amalgamation occurs when two or more companies decide to unite to carry on their business together. So amalgamation simply means when two companies, two or more, decide to form a unique business or to come together to form a good business. The amalgamation of companies can be done in form of absorption and consolidation. So we can also call it this. I mean, uh, absorption is also the same thing as amalgamation, or you can call it consolidation. Then this absorption is a form of merger where there's combination of two or more companies into an existing company. Simply means two or more companies come together to form a unique or an existing company. And the main purpose to open, so there's need for us to open a realization accounting. So it's compulsory. We are going to open it. The purpose for doing this is to ascertain profit or loss due to the asset and liability. So we are going to open the realization account when we get to the normal accounting procedure. So we are going to look at the preparation of realization account. So we are going to look at it, the realization account. So we are still going to prepare the account of realization account. So let us look at the types of amalgamation accounting. The first one we have amalgamation in the nature of merger is, and this type of amalgamation not only is the pooling of assets and liabilities. Now, when we're talking about assets, these are the property of the company, the resources of the company. But liabilities is the obligation of the company or the indebtedness of the company that the company is that the company want to pay the outsider, and this is done this is done when the shareholder interest and the business of this company are combined together. So in other words, all assets and liability of the transfer of company become that of the transferring company. So uh, the company that want to transfer the assets, we transfer to the transfer company, and it will become it will become the asset of that company that want to absorb the company. So there is no any adjustment intended to be made to the book value. So simply means there won't be any uh, adjustment to be made in this type of account. The amalgamation in the nature of purchase. So amalgamation, this method is considered when the condition for the amalgamation in the nature of merger are not satisfied. So when the condition that forming the, combining the two, I mean, combining the two companies together are not satisfied. So it's possible when they combine the two companies together and their aim is not well satisfied. So that is amalgamation, the name of a purchase. Then the shareholder of the company, which is acquired normally, do not continue to have proportionate share. So the shareholder will not have proportional share in this type of company, or will not have proportionate share in the equity of the combined company. Simply means the shareholder will not entitled to any equity, any capital from this company, or the business of the company which is acquired is generally not intended to be continued, or maybe the business is not intended to be continued as well. So that is the types of amalgamation accounting. Let us look at the procedures for amalgamation. One, adoption to merge the different firms by the board of directors. So it must be from the opinion of the board of directors to merge company A and company B together to become AB company. Or they can see the opinion of the board of directors to merge different firms together. Two, the plan to merge must be approved by the two-thirds. Let's say we have 7 shareholders, at least two-thirds of the shareholders should be able to agree, or should be able to agree or approve by the two-thirds of the shareholder of both firms to merge company A and company B together. Then that is for the second one. Then let us look at the third procedures. All necessary documents must be submitted to the registrar of companies, both companies. They have to, all the documents must be submitted to the registrar of a company before they can merge the two companies together. Then the fourth one, the registrar of company issues a certificate of merger. So because they have company A before they merge together, as its own certificate. The same thing, likewise, the same thing for the company B. But the new certificate of merger will be issued to them, to both companies. That will be AB companies now. So they have to issue the certificate of merger to both of the company, to company, to the company, to the company A and B. So they have to, it's possible from the register of company to issue that certificate of merger to both company. Then let us look at the reasons for amalgamation. One, a company may merge with other companies in order to diversify its range of products. Maybe they want to change the range of product, what they are selling before. So maybe as a result of that, that's why they want to, maybe they are selling biscuit before and they want to divert to be selling beverages. So it's possible they can do that as well. Maybe it's due to the reason. Maybe biscuit is not selling well, and beverages are the one selling in the whole country. Maybe that is the purpose of the reason why they want to merge the two companies together. Then the company merge in order to reduce the cost of production. So there's no how when both companies merge together, the cost of production will be totally reduced, because the cost they are going to incur for producing the particular product or commodity will be greatly reduced. So then business comes together for the purpose to reduce or completely eliminate competition between rivals. Maybe they want to eliminate a competitive firms. So it may be as a result of that, A and B will come together to form AB, and they can try to eliminate Z company as a result of the coming together of both company A and company B. Then lastly, a company merge in order to improve efficiency of productivity. So the company may merge together because as a result of improving the efficiency of the productivity. So it may be as a result of that. Then let us look at the calculation aspect here. We have example here. The following are the balance sheets as on 31st December 2013 of S Limited and Y Limited. So this is S and Y. We are going to look at this S and Y balance sheet. We have the liability sides and we have the asset side. Under the asset side, we have land and building. The land and building we have is 30,000 naira for S Limited. Plant and machinery. Then Y Limited, no land and building. Then plant and machinery for S Limited 110, for Y Limited 50,000 stock, 16,000. Then Y Limited is 8,000. Debtor is 14,000 for the S Limited. Then Y Limited is 9,000. We have cash 3,000. Then Y Limited is 1,000. That is for the asset side. For the Y Limited, we have 173,000. For the S Limited, we have 68,000 naira. Then under the liability side, we have equity share capital 100,000 for Y, for X. Then Y 60,000 naira. 6% debenture of 10 naira each, 20,000 naira. Reserve 34,000 naira. No, we don't have for Y Limited. Dividend equalization fund 4,000. We don't have for Y Limited. Trade credit of 13,000. Then Y Limited is 8,000 naira. Profit and loss account 2,000 naira. By the time we had all the liability side of S Limited, we have 173,000 naira. Y Limited is 68,000 naira. This is the question aspect. Then we are still going to look at the additional information given in the question here. Additional information given in the question. So we are going to look at it. Let us look at the additional information here. In January 2014, the two companies agreed to amalgamate, to come together as a unique company, or to unite together to become to become a combination account, a company. So in January 2014, the two companies agreed to amalgamate and form a new company. And the name of the new company they are going to form is Z Limited. Mind you, I told you that that balance sheet is for the X and Y Limited. But they decided to form a new company, and the name of the new company is Z Limited. Take note. Then which takes over the assets and liability of both the companies. The authorized capital of Z Limited is 1 million naira, consisting of 100,000 equity shares of 10,000 naira each. The purchase consideration is agreed, 20,000 naira. That means the 20,000 naira for S Limited and 60,000 naira for Y Limited, respectively. The entire purchase consideration is to be paid by Z Limited in its full paid shares in return for the venture in S Limited. The debentures of the same amount and denomination are to be issued by Y Limited. Then prepare the opening balance sheet of Z Limited. So we are going to prepare this the balance sheet, the opening balance sheet of S Limited. So we are going to start with the sundry shareholders. Under the sundry shareholder, amounts recorded as share capital, that is 120. I said the other time. Then less share capital of X Limited, 100,000. So when you less it, you are going to get 20,000 naira. And that 20,000 naira will serve as sundry shareholders. That is for the sundry shareholders. Or you can call it amount to be adjusted in reserve account. Let us look at the reserve account. Under the reserve account, our balance sheet, the balance sheet we are given, if you can still remember, we are given 34,000 naira. So you are going to subtract it from this amount given. The amount given, the balance we calculated from the sundry debtor is 20,000. So we less 20,000 naira from it. Then we have balance of reserve of 14,000 naira. That means 20,000 naira subtracted from 34,000 naira, you get 14,000 naira. So that is for the share, for the sundry shareholders account and a reserve account. Mind you, we have uh, sundry shareholders, 20,000 naira. And as well, we also have the reserve account, balance for reserve account, that's 14,000 naira. That means we have 20,000 naira for sundry shareholders and 40,000 naira for reserve account. So in case when we get to the balance sheet, we are going to make use of all these additional or adjustment account. So we have trade creditors account. Under we have SYS limited creditors, that is 13,000 naira. Y limited creditor is 8,000 naira. So add 8,000 naira and 13,000, you get 21,000 naira. Then plant and machinery account, S limited machinery, that's 110. Y limited machinery is 50,000 naira, that's 160. So my students, we are still going to be using all this when we get to the normal preparation of opening balance sheet. So we also have stock account. We have Y limited stock, 16,000 naira. S limited stock, 16,000 naira. The Y limited stock is 8,000 naira. By the time you had 8,000 and 24 together and 16 together, you are going to get 24,000 naira. So let us look at the other one, which we are given there. The other one is that is debtors account. We have S limited debtors, that's 40,000 naira. Y limited debtors is 9,000 naira. So we had the two together, then we are going to get 23,000 naira. Then cash account, S limited cash 3,000. The Y limited cash is 1,000 naira. 3,000 and 1,000, the addition of both will give us 4,000 naira. Then that is, let us look at the revaluation account now. Revaluation, or you can call it realization account, it's still the same thing. Revaluation or realization account. We have for S limited here and Y limited here for both sides, for both debit side and credit side. So for the debit side, we have land and building, 30,000 naira for S limited. For Y, we don't have anything. So plant and machinery, 110,000 naira, and for Y is 50,000. Stock, 16,000 naira. While for the Y limited is 8,000 naira. Debtors is 40,000 naira for S limited. Then Y limited is 9,000 naira. That is. Then we also have cash. The cash is 3,000 naira for S. Then Y is 1,000 naira. Then we go to the liability side. That is 6% of the venture, 20,000. Nothing. We don't have anything under the Y for the Y limited for the debenture. So trade creditors, we have 13,000 naira for S limited, and Y limited is 8,000 naira. Purchase consideration, mind you that we have been given, or you can call it capital account. So for the S limited, we have 420,000 naira, and we also have for Y limited 60,000 naira. Then I told you that we are going to make use of these sundry shareholders, 20,000 naira for Y, and we don't have anything under the Y limited. We have 20,000 naira for S limited. So you can see that both sides of the account are equal. Both sides of the account are equal. We have for S limited debit side the 173. For the S limited credit side of realization account, we have 173. Y limited for realization account, we have for the credit side, we have for 68,000 for Y limited. Then for debit side of Y limited, we have 60,000 naira. So that is for the balance of how to calculate the realization account under the amalgamation account. So let us look at the balance sheet. This is where we are going to look the work properly now. Then I want to start with the asset. Assets under here divided into two. We have fixed asset and current asset. Land and building, 30,000 naira. Mind you, we've calculated that one under the working. So we add them together for both X and Y. You check it, you still see that you get 30,000 naira. The plant and machinery 160,000 naira. So that is for the fixed asset. We have 190,000 naira for fixed asset. Under current asset, we have stock 24,000 naira, debtors 23,000 naira. Then we also have cash. This is cash. This one is cash. Cash. It's 4,000 naira. So at the end of the day, we have 241,000 naira for the asset side. Let us look at the liability side. Mind you, there's nothing like debit or credit side in balance sheet. So just a financial statement to show the financial position of the business, just to show the asset and the liability. So if the liability is more, if the asset is more than the liability, that means the business is going concern concept, can run for the business can also exist for the I mean for the for the uh, for the next uh, 5 years to come, the business can still be in existence. So that is under the asset side, where we have fixed asset and the current asset. Then under the liability, we have share capital. Under the share capital, we have authorized capital, 1 million naira. So we have to close the account of this 1 million naira as not part of it. Then issued, this one the company was able to issue out from this 1 million naira of the shares. So, and she issued and subscribed capital, 180,000 naira, reserve and surplus. Under the reserve and surplus, we have reserve for 2,000 naira, profit and loss account, 2,000 naira, dividend equalization, that is 4,000 naira. Then we also have secured loans, that is 6% debenture, 20,000 naira. Then we have current liability, trade creditors, 21,000 naira. So when you add everything together, we are still going to arrive at the same answer. That is 241,000 naira for both the liability and the asset side. So mind you, there's nothing like debit side or credit side under the balance sheet, just liability side or asset side. That's the way you call it, my student. So this is the end of the class for today. Please go to this textbook, the recommended one. That is a simplified and amplified bookkeeping and accounting by one of the chartered accountants in the country. That's OA, Olatuji Alonge. That is Olatuji Alonge. That's the name of